It is Sunday night, January 11th, 2026. Welcome back, Iron Financial. If you just checked your phone or fired up your trading terminal to prep for the week, you are staring at a sea of red across global futures markets. You aren't imagining it, and no, your data feed isn't broken. We need to talk about the incredible whiplash investors are experiencing right now. Think back to just 48 hours ago. We closed Friday afternoon popping champagne. The jobs report was the definition of a Goldilocks scenario. The economy was cooling just enough to satisfy the Fed, but still growing. The S&P 500 punched through to yet another all-time record high. The narrative wasn't just good, it was flawless. The consensus was that the soft landing was here, the bulls were in total control, and complacency was at an all-time high heading into the weekend. But the weekend is over, and reality just punched this market square in the face. The second the futures markets opened for trading at 6 p.m. Eastern tonight, the trapdoor opened. Dow futures dropped nearly 200 points almost instantly. S&P and Nasdaq futures are sliding right alongside them. This wasn't a slow bleed, it was an immediate, violent repricing of risk. Why? Because a geopolitical bomb just went off. But this didn't happen overseas. This bomb just detonated right in Washington, D.C., in the space directly between the White House Department of Justice and the Federal Reserve headquarters. Tonight, we are breaking down the unprecedented, breaking conflict involving Fed Chair Jerome Powell. This isn't just another political headline. This is a potential constitutional crisis with your portfolio caught directly in the crossfire. We're going to explain why Wall Street is terrified of this news, and exactly what it means for your money when the opening bell rings tomorrow morning. Buckle up. The catalyst for tonight's sell-off is a story that broke late Sunday, and frankly, it's stunning. It's the kind of Friday news dump that usually gets buried, but this one was too explosive to ignore. According to reports now confirmed by the chair himself, Jerome Powell stated that the Federal Reserve was served with a subpoena by the Department of Justice on Friday. Now, let's look at the official reason given on the paper. The threat is a potential criminal indictment against Powell regarding cost overruns at the Fed's headquarters renovations in Washington, D.C. On the surface, this sounds like bureaucratic accounting boringness. Government building projects go over budget all the time. Why would the stock market crash over drywall and plumbing costs? The market is crashing because nobody, and I mean nobody on Wall Street, believes this is actually about building renovations. Think about the mechanism here. The Department of Justice doesn't usually get involved in GSA-level construction budget issues unless there is massive, obvious fraud. To target the sitting chairman of the Federal Reserve personally over construction costs is like using a tactical nuke to deal with a termite problem. It is highly unusual, and to institutional investors, it smells entirely political. Powell immediately came out swinging tonight. He isn't taking this lying down. He characterized this subpoena not as a legitimate investigation, but as naked intimidation. He is framing this as a direct pretext by the administration, specifically President Trump, to pressure the Federal Reserve into cutting interest rates faster than the economic data supports. We need to contextualize this feud. This isn't new bad blood. We know the history. During his previous term, and relentlessly throughout this current one, President Trump has attacked Powell for keeping rates too high. We've seen years of angry tweets. We've seen public speeches where the president called the Fed boneheads and threatened to fire Powell. The market grew accustomed to that noise, they treated it as political theater. But this? This is not theater. A mean tweet is one thing, a DOJ subpoena threatening criminal charges against a sitting Fed chair is a nuclear escalation. It moves the conflict from the court of public opinion into a literal federal court. Why is this incredibly damaging right now? Because it's what experts call lawfare. Even if these charges go nowhere, think about what this does to Jerome Powell over the next 6 months. Instead of focusing 100% on navigating a tricky inflation environment and a cooling jobs market, he and his senior staff are now going to be bogged down with white-collar defense attorneys. They will be distracted by document discovery and depositions. It is a massive distraction at a critical juncture for the economy. It weakens Powell's hand. Every time he steps to a podium now to talk about interest rates, the shadow of this indictment is standing right next to him. Investors are selling tonight because this is no longer just a policy debate about 25 basis points versus 50 basis points. It has become institutional warfare. If the executive branch can weaponize the DOJ to force the hand of the person in charge of the world's reserve currency, the rules of the game have fundamentally changed. The market is suddenly questioning if the adults are still in charge in Washington. Let's take a step back, because it's crucial to understand the mechanics of this panic. Why did sophisticated high-frequency algorithms immediately dump stocks the second this news hit the wires on a Sunday night? Why does this abstract concept of Fed independence matter more to your portfolio than almost anything else? The entire modern global financial system, trillions upon trillions of dollars, is built on a foundation of trust. And the cornerstone of that trust is the belief that the U.S. central bank makes decisions based on cold, hard data, inflation prints, jobs numbers, GDP growth, for the long-term health of the economy, regardless of who is sitting in the White House. The conflict of interest here is inherent. Politicians, by nature, operate on short election cycles. They always want lower rates because cheap money makes voters feel richer right now. But a central banker's job is to take away the punch bowl just as the party is getting good. If a central bank caves to short-term political pressure and cuts rates when inflation is still simmering, you don't just get a temporary sugar high. You risk a disaster. We aren't just guessing about this. We have a historical playbook. Look back at the early 1970s. President Richard Nixon heavily, and privately, pressured then-Fed Chair Arthur Burns to keep money cheap to ensure his re-election. Burns eventually caved to that pressure. The result? The Great Inflation. A decade of stagflation that destroyed the purchasing power of savings and crippled the economy. The market knows this history well. Powell is standing firm tonight because he refuses to be remembered as the next Arthur Burns. Furthermore, you have to consider the global context. Why does the whole world hold U.S. Treasuries as the ultimate safe asset? Why is the dollar king? It's not just our military might. It's the absolute bedrock faith among global investors that the U.S. Federal Reserve is the adult in the room, immune to the whims of partisan politics. If the world starts viewing the Fed as just another political arm of the executive branch, no different than the central banks and emerging markets that are constantly battling hyperinflation, that reserve currency premium gets shaken. The market is terrified tonight because if Powell is removed, or even just successfully coerced into submission via legal threats, the Fed's credibility evaporates instantly. And here is the exact mechanic of the sell-off. If the bond vigilantes, the massive institutional fixed-income traders, believe the Fed is compromised and will let inflation run hot for political reasons, they will revolt. They will sell treasuries, driving yields straight up. And when risk-free yields spike rapidly, it immediately crushes the valuations of stocks, especially the high-growth tech names that have driven this entire bull market rally. Tonight's action isn't just about an indictment, it is the market violently pricing in a sudden, massive spike in institutional risk in the United States. Now, if the Powell situation was the only thing happening, this sell-off might be contained. We've seen political theater before. But here is the critical context that the mainstream news might miss. This news landed on a market that was desperately looking for an excuse to take profits. Think about where we ended Friday. The S&P 500 at all-time highs. The Nasdaq absolutely roaring. We have had an incredible run since last November based on the idea that the soft landing was achieved and rate cuts were imminent. But when you are at all-time highs, valuations are stretched to the breaking point. The market was priced for perfection. When you are priced for perfection, you cannot afford any bad news, let alone a constitutional crisis involving the central bank. The ice under the market was already incredibly thin, the DOJ just stepped onto it with a sledgehammer. Furthermore, the geopolitical landscape was already making traders nervous this weekend. We have the ongoing situation in Venezuela. Following the recent U.S. moves to assert control over oil assets there, the rhetoric remains incredibly hot. This isn't just political posturing, it directly threatens global energy supply chains. Add to that the simmering tensions with Iran, and you have a recipe for spiking oil prices. Why does that matter tonight? Because if energy prices spike due to conflict, inflation comes roaring back. That makes the Fed's job infinitely harder, right at the exact moment the Fed chair is being politically kneecapped. And finally, look at the calendar. The timing of this crisis is almost unbelievable. We are facing an absolute gauntlet of data this week. Tuesday morning, less than 36 hours away, we get the CPI report. The crucial inflation data. Before this Powell news broke, investors were already sweating this number. If CPI comes in hot on Tuesday, the narrative of rapid rate cuts dies. Now, imagine a hot CPI print while the Fed chair is fighting an indictment threat. It's a worst-case scenario for the bulls because it suggests inflation is sticky and the only man with the tools to fight it is under siege. We also have major bank earnings kicking off later in the week, setting the tone for corporate profit expectations. The bottom line for this section, the market was already positioned nervously, holding too much risk ahead of a massive data week. The Powell versus DOJ conflict wasn't just a spark, it was a blowtorch dropped into a room full of gasoline. So, where do we stand right now, Sunday night, and what happens when the real volume hits tomorrow morning at 9:30 a.m. Eastern? Right now, futures are down about 0.5% across the major averages. In isolation, that's painful, but it's not a full-blown crash yet. What concerned me most wasn't just the drop, but the velocity of the move. When that Powell news hit the tape, there were no buyers. The bid just evaporated. That tells you this is a high-conviction reaction by algorithmic traders to a brand new, unpriced risk. Tonight, you need to watch the flight to safety trade like a hawk. Look at that screen. Are bonds rallying? Remember, when bond prices go up, yields go down. If the 10-year note is rallying hard tonight, it means the market is terrified that this political chaos is going to stall the economy, forcing the Fed to cut rates not because inflation is beat, but because things are breaking. Watch gold. Watch the Japanese yen. If those defensive assets are spiking while stocks are dumping, it confirms that big institutional money, pension funds, sovereign wealth funds, are moving into bunker mode to protect capital. They are de-risking, period. Technically, here is the danger zone. We just spent all last week breaking out to glorious new all-time highs. The absolute worst thing that can happen from a technical standpoint is what we call a failed breakout. If we open tomorrow morning with a massive gap down, and we slice right back through those previous highs we just cleared on Friday, that is a massive bearish signal. It traps every single bull who bought the breakout late last week. If those prior resistance levels don't turn into support, look out below. The selling pressure from trapped longs puking their positions could accelerate things very quickly. The bottom line is this: the market can handle bad economic data. It can even handle wars overseas. What it cannot handle is structural uncertainty about the rules of the financial game. We just got hit with a constitutional standoff over who controls the US money supply. You cannot model that in an Excel spreadsheet. Do not be a hero tomorrow morning. The opening 30 minutes are going to be wildly volatile as institutional desks react to whatever headlines break overnight. This is now a news-driven market. The fundamentals don't matter until we know if the Fed chair is going to be indicted. Let the dust settle. Keep your position sizes small and your stops tight. Thanks for watching this emergency update. Stay safe out there. I'll see you in the morning. The information provided in this video is for general, informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.